Greetings, ladies and gentlemen. Hope your day is good. Welcome to Financial Literacy Simplified. Today, I want us to learn about the considerations that you need to make if you want to take a loan. You will allow me to do a slide presentation so that we can be able to learn more. And the first consideration that we need to make we need to ask ourselves, do I need this loan? When you ask yourself whether you need this loan, what is it that you want to do with this money? Are there other alternatives that are available? Whatever I want to do with this money, can it wait for my savings? Now, is it a must I take this loan? You find in some developed countries, especially matters to do with credit cards, you will be required to have a credit score. And credit scores normally are given if you take loans. So like somebody goes from Kenya to the US and you need to rent your own apartment, they will need you to have a credit score. And in the developed countries, you find the usage of credit cards gives you credit scores or credit rating. Here in Africa, and Kenya to be precise, you may find that some chamas require that for you to earn their dividends or interest, you must have taken a loan. So you will ask yourself, is it a must I take this loan? The next one that we shall look at, what is the cost of this loan? A loan comes with costs. We are talking about the interest cost. We are talking about the insurance cost. We are talking about the processing cost. What is the cost of this loan vis-a-vis how much will I get? If we talk about the interest cost, you will ask yourself, can I afford the cost of this loan? If you are taking a loan of 100,000 and all the costs put together come to 40,000, is it affordable? The next part you may need to ask regarding cost, how was this cost arrived at? I have taught previously about the various costs: interest on reducing balance, interest on straight line or flat rate method, and interest on amortization method. I told you that reducing balance is mostly for SACCOs, amortization is for banks and a few SACCOs. Straight line or flat rate is majorly for asset finance. So how is this cost? And remember, if you compare like the cost if there's somebody is saying it is 12% reducing balance and another one is saying 12% flat rate, remember it is as different as the earth and the sun. They are worlds apart. So what is this cost? And then regarding these costs, somebody tells you the interest we are charging at 10%, at 12%. Is it 10% one-off? Is it 10% for 6 months? Is it 10% for a quarter? Or is it 10% per annum? Also regarding the cost, we shall ask ourselves, are there hidden charges? You may find, apart from those costs that are clear, there are other costs that have not been indicated that come maybe when you pay the loan, there is some loan charges for processing and so on. But most of the institutions that are regulated, most of the societies that are regulated by SASRA, and most of the banks that are regulated by central bank, you find it is a requirement that these costs should be put in black and white. So most of the times you find this is not in all institutions. The other aspect regarding the cost, you will ask yourselves, are these interest rates fixed or fluctuating? A fluctuating interest rate is varied. Maybe you took a loan at 12%. After 8 months, now the cost is at 14%. After 8 months, the cost is at 20%. Are they varied in the cost of the loan? Remember, if it is fixed, it will help you to plan. The next after the costing is how long will I pay this loan? How long will I pay this loan? The duration of the loan is very critical. Remember, if the loan is for a longer term, the interest rate you expect will be higher. If it's for a shorter term, the interest rate will be shorter, or it will be lower, sorry for that. So the longer the term, the more amount you will also qualify. If you wanted, your payslip may not allow a loan maybe for 2 years, but if it is spread in 4 years, you may find your payslip may accommodate. So you will ask yourself, this loan that I want to take, for how long do I want to pay this loan? And the longer the duration, for some circles, let me not say most, things like insurance charges, you will find it will also be spread over the period. So a loan for 2 years will not pay the same insurance fee as a loan for 5 years. You will also need, regarding the duration, to do matching. Don't take a short-term loan to solve a long-term project. And also do not take a long-term loan to solve a short-term project. You need to pay some debt that you took from, let's say, mobile banking loans. You go to your bank and take a loan for 3 years. Is it worth? No. The next item you will ask yourself, do I have a backup plan? In the worst case scenario, God forbid, you are unable to pay. Do I have a backup plan? Imagine you took a mortgage, you are employed, you charged the mortgage against your salary, and now you lose your job. What will happen? If you do not have other income, you may find you losing your house. You took an asset finance, you took a loan basing on your employment income or basing on your business income, and it goes down. They will repossess that vehicle. So where do you have a backup plan should the worst case happen? Remember, in accounting, we say that you hope for the best, but prepare for the worst. The next is, will this loan complete the project that it was intended to do? I will tell you, if you take a loan where it is heavily hitting your pay slip or your business income, and you may not be able to complete that project, do not take that loan. You may find you will not be able to chew what you did, what you decided to bite. So if it cannot complete a project, it will have a toll on your financial well-being. If you are taking a loan so that you will stop paying rent and you are unable to complete that house, remember, you will still be paying rent and you will be paying loan interest for that house, and you will still be paying the principal. it will be a double hit on you. The last one that we shall ask ourselves, what will be returns from that loan? Returns here, I need to correct here, will be positive or negative returns. If when we talk about negative returns, there are loans that you will find yourself having negative returns, but yes, as much as they have negative returns, they are necessary. There are some loans with negative returns that will not be necessary. Take, for example, if you decide to take a loan to go on holiday, you are paying interest at 15%. It will give you negative returns, but is it necessary? No. You can be able to, it is not a must. You go for holiday. You have a medical bill to take care of, maybe for your spouse, for your child, for your parent. This loan will give you a negative return, but is it necessary? Yes. There are some loans that will give you positive returns. Take, for example, you want to take a loan for your school fees so that you will get promoted in your place of work. You want to take a loan so that you will undertake a training that is necessary. You want to take a loan to complete a project. There are some people in real estate, you find you have done all 95% of the project. It is only fine finishing